Welcome back, Alpha Hunters. Okay, so I just did a review of LUV Southwest Airlines (LUV), and we came up with a plan to generate 57.7% of annualized returns. And the cool part about that is that was mostly built around a cash flow strategy with the wheel. So go ahead and check out the analysis right here. So starting out with LUV, what I really wanted to try to do was try to bring in something that looks a little different. And airlines are definitely different right now. They really haven't been part of much of the COVID recovery that's gone on for the past 2 years. So these are a little tricky, but we'll look at LUV here and see what we can figure out. So let's look at a long-term chart. We'll look at a 1 month. And what we can see is it's really been in the same kind of pattern since, or the same price range since about 2015. And we've had some peaks of about 67 points. And the COVID bottom was around 23 points. But outside of that COVID bottom, we've really been mostly at a bottom of around 30 points, okay? And that was still the kind of a COVID low, but we did have a low of around 31 points back in July of 2015. So really we've just been in a range. So that kind of leads me to think we're still just range bound. I do think airlines will start to be a little bit more bullish. Probably not anytime in the next year, but I would say after that. The mindset I have is they haven't been participating much in the recovery. So I kind of think they will stay range bound for now. I think any significant dips that airlines have, I believe they will get bought up because they are still discounted. People are starting to get back out there and travel more. We're starting to see more travel restrictions taken away. So you're getting a little bit more freedom to travel and that kind of stuff, especially internationally. So this kind of is a benefit to travel stocks as it makes it easier for people to travel. So as we do get any dip buying activity, I would definitely expect people to buy it up, expecting them to get back to a normal business cycle, normal productivity, probably within the next, I would say, year and a half, 2 years. And if we do go into a recession, a lot of people talking about that. You see a lot of stuff about that in the news. Currently, sometime in the next year and a half, 2 years, then I don't know how much the airlines will be hit because they've never really had that recovery. So this could be an area that could actually not be a bad area to start dipping your toes, as I don't see much downside with the airlines. And I think LUV has usually been one of the best of breeds in the airline stocks. And that is one reason why I'm looking at LUV today. So on LUV, looks pretty market neutral for now. I would expect some bullishness to come in down the line. But for now, we're going to look probably more at market neutral strategies and just try to see if we can just bring in as much cash flow as possible. The thing here on LUV is they actually used to pay a dividend, but actually, do you see it down here? They had earnings back in October, they had earnings in January, but there's no dividend payment anywhere down there. So let's go look and see when the last time they paid a dividend. And it was actually during the COVID crash. Right as COVID crash was happening, that was the last time we paid a dividend. So they probably just took it off the board. A lot of companies are just trying to save as much cash as possible. So that makes some sense on their part. And that is another thing, if you do wind up becoming a shareholder, you could probably expect them here in the next 2 years, if things get back to normal, to probably get that dividend back going. Let's see what kind of dividend they were paying. They were paying 18 cents a share. So that would be an annual yield. That would be about 72 cents a share annually. And let's say if they pick that up now, we'll just divide that by the current stock price of 41. That'd be roughly a little bit under a 2% dividend yield. So not horrible, not the best, but obviously we can't really factor that in now. I would expect them to probably continue that maybe in like 2 to 3 years as things probably normalize a little bit better for the airline companies. So we're going to really have to count on our options and option income to generate the cash flow that we want. So we've really been range bound for most of this year, really between the 38 point area, which let's say probably down in this area, maybe like 39 to roughly somewhere up in here, maybe about the 46.5 to 47. So that's really where we've been stuck most of the time. When I'm first looking at this, the major strategy that really kind of pops off to me is the wheel, because there's not much downside here, I think, on LUV. So the wheel probably would be a really solid one to go with. The other one that really kind of pops off is maybe doing some iron condors and selling some iron condors and bringing in some income, where basically you're selling a bullish vertical below this line and then selling a bearish vertical above this line. So that could be something that you could look to definitely do. And you know what, you can kind of stagger them as it gets close to the line down here. You can maybe do a bullish vertical down below the line. If it gets above the upper line, you do, or it gets close, if it gets close to the upper line, you do a bearish vertical up here. That way you can just kind of stagger it. Okay, so let's take a look at some options. I want you to leave a stock in the comments below, and I'll come up with a trading plan. They actually have some decent options. They do have options that go 6 weeks out, so that is actually nice. So we can do some option flexibility. And we also have options that go for Jan of next year and the Jan of 2024, which would be the year after that. So that's also very nice. So let's go ahead and look and see if we can set up something very nicely with the wheel. So if we did do that, obviously for the current week I'm on, it's going to be a 4-day trading week. So April 14th is going to be the last trading day of this week. The markets are closed Friday. So we can look at that, or we can look at the Friday after. I'm kind of been thinking about looking at the Friday after and seeing what we can bring in some cash flow. And honestly, this might be something I probably will do. And what I'm going to look to do is really just kind of stick with the wheel. We are coming down into the lower areas of that channel, right? This channel. And so as we get lower to that line, I might be thinking more to do a bullish, some kind of bullish vertical down here. And the one that would pop off to me would be to sell potentially a bull put vertical. Okay, but right now it's in the middle here, so I'm not really going to worry about doing that. I would really like to sell a cash secured put and set up a wheel strategy type of move. And so if we do 2 weeks out, we could actually bring in roughly $1. Okay, so roughly $1 for 2 weeks out. So if we do 2 weeks out, we could collect, let's say down at the 40-50 strike, we could collect 91 cents or almost $1. If we did the 41, which the market looks like it's going to be around the 41 when it opens, it'll be a little bit over $1. So it just kind of depends on, you know, what you want your trade-off to be. I do like going a little bit lower here because it looks like we do have a pretty good channel coming down, as we probably are making a move down to this lower support line. I think doing a cash secured put and setting up the wheel strategy looks really pretty solid. And then you just turn around and sell the covered calls. So I would look to probably sell this 40-50. I do like doing that. I do like doing it as short term as possible, but since we got a short week, maybe not so much. We could do 50 for, actually we could do 50 cents for this week. And then assuming we can get 50 cents again for the following week, that might not also be a bad way to go either. But I don't want to do 50 cents this week and then it just gets below it and then I'm already into it. I'd rather just go ahead and do this 91 cents for 2 weeks out. And maybe we get a bounce and I don't actually have to take on the shares. I can just actually roll right into selling some options again on it. Might not be a bad way to go. So I'm gonna look to do that. I'm just gonna look to sell this 2 weeks out 50 strike put for 91 cents. And the cool thing about selling that one is if we sell 91 cents and then multiply that by 52 and then divide that by 2, because we're only going to bring in every 2 weeks and not every week. 52 weeks is looking to represent for the whole year, but really we're only looking to do half of that. We'd be looking to bring in 23.66 if we did this for the whole year. We never really got exercise or anything like that. So this would be like an annual rate of a little bit over half the value of the current stock price. So if we're looking to bring in about 23.66 of cash and the current market price is 41.02. Now that's a per share basis. So if you do want to get on a per contract basis, you just times that by 100 and you're looking to be bringing in $2,400 annually per contract on the option. That's also not a really not a bad way to go. I think it's a pretty safe way to go. And I think in our current marketplace, that is a crucial word to kind of be using when we are looking to do strategies, is safe. We're not looking to use a lot of risk. Right now, I don't think it's a good time to have a risk on the table. So I do like this 23.66. To bring in that amount of cash per contract annually, that's really not a bad way to go. And then if you want to turn around and then let's say you get assigned shares, what you want to do, let's say we get to April 22nd, we get assigned shares. We'll say the stock winds up dropping to 39.50. We get assigned shares at 40.50. What you then want to do is go out to the next week. And if there's none traded, it looks like there's not even trading at the 40.50 strike, that's fine. Go to the one strike above it, which in this case would be the 41 strike, and sell, not on the put side, but on the call side, you want to sell that strike. So not the 40.50, but you go one strike above it, the 41, and then you're looking to sell the calls so they get called away. And in that case, you can bring in cash. Now, you won't be able to get this $1.76 because that would be technically a week out. But what you want to do is, if you don't like the premium that you'd be getting at that strike, what you do is you just go out to the next expiration and you look at that strike again, that same strike price. You just keep going until you get to one where you like the value that you'd be getting for selling a covered call at that expiration and at that strike. Okay, so that's what you definitely, and that's basically how you manage the wheel. And then once the stock comes back and gets above the strike that you sold for that covered call and you collect the premium, your shares called away, then you lose your shares, but you collected the cash flow from the put and however many calls and puts you sold, and that makes your trade profitable and work out in your favor. So you can just keep going out and selling the 40, 41.50 or the 40.50s or the 41s, or you get to the point where you get to a quarterly dividend and they don't have a 40.50 or 41, I would still go above the one that you sold originally, because if you ever do go down, it is possible that you wind up losing money. So I would just go to the 42.50 in this case, and then just sell that for potentially whatever you can get for it. And then these weeklies have them every point. Just be mindful of what you are looking at. But like this 41, you could also get back to selling that 41. So it looks like the weeklies you'd be able to sell potentially on every one whole point, but you definitely want to make sure that you stay above on your covered call that you're selling. You stay above the strike that you sold for your put Okay, because it is possible to actually lose money with the wheel strategy. I get a lot of people don't realize that, but it is possible. So you definitely just want to stay above, or really just know what you're doing with the prices and just understand how the value works out. Okay. But that would be the best way I would plan to trade or really look to do any kind of airline stock currently. And LUV is one of the better breeds in this area. As you know, we just want to protect cash currently, protect risk. I don't have any issues with them potentially defaulting or anything like that. And I think eventually they will get back to being a more of a bullish type trend. They'll probably go through a bullish period in a few years as things kind of get back to normal, potentially as we come out of a recession or whatnot. I would not look to short this, as I think any kind of dip buying opportunities, I think they will be bought up, as they really haven't had that extreme run to get to extreme valuations like we've seen in other names in the marketplace. So I wouldn't be looking to short them by any means, but if you do want to start accumulating a stock position into your portfolio and start writing some covered calls over top of it, not a bad way to go. The wheel is also a really good way to go because you can generate cash flow as you do accumulate the stock positions. Okay, but bringing in roughly about $2,400 here of annual cash, and then roughly we got a value of 4,100. So that'd be, so far, if you did do the whale strategy, you're looking at about roughly an annualized return of somewhere around 60%. It looks like 57.7%. So that's really not bad, you know. And really, that's kind of what we're looking for. We just want to bring in cash. We want to protect capital. We're not looking to lose value in any way. So we just need to stay disciplined and bring in cash flow when we can. Find good value names where we don't really have to worry about them potentially going out of business or anything like that, or having severe loss of value. And I do think the airlines are probably fitting that mold as not losing value due to them not having a rapid increase in value from the COVID bounce. Alrighty, take care, Alpha Hunters.